Hi, and welcome to our presentation about Special Purpose Acquisition Companies, or SPACs for short. Today, Aisyah, Ethan, Logan, Jonathan, and myself, Tim, will be discussing what SPACs are, the pros and cons of using SPACs, how warrants are accounted for, and accounting issues related to SPACs. So what are SPACs? Special Purpose Acquisition Companies, or SPACs, are shell companies that have no commercial operations and are formed strictly to raise capital through an initial public offering, or IPO, for the purpose of acquiring or merging with an existing private company. The funds raised through an IPO is held in a trust account and is generally invested into an interest-yielding instrument. SPACs are under a limited schedule and must complete a merger or acquisition within 24 months, or the funds must be returned to investors. SPACs are also known as blank check companies, as investors can purchase shares or units without the knowledge of the eventual acquisition or business combination. A SPAC may identify in its IPO prospectus a specific industry or business that it would target as it seeks to combine with an operating company, but it is not obligated to pursue a target in the identified industry. An example of a SPAC was a 49% acquisition of Virgin Galactic for $800 million by social capital Sophia, which helped take the company public in 2019. Capital raising for SPACs. As SPACs do not have a financial history, they are reliant upon high-profile sponsors or management teams to gain traction for their capital raising. Generally, a SPAC is formed by an experienced management team or a sponsor with nominal invested capital, typically translating into approximately 20% interest in the SPAC, commonly known as founder shares. The remaining 80% interest is held by public shareholders through units offered in an IPO of the SPAC shares. Each unit consists of a share of common stock and a fraction of a warrant. Initial business combination. Following the IPO, proceeds are invested into short-term securities or interest-yielding instruments. The SPAC then searches for a target company to acquire or merge with. This is usually a lengthy process, averaging 15 months. Once the SPAC has identified an initial business combination opportunity, its management negotiates with the operating company and, if approved by SPAC shareholders, executes the business combination. This transaction is often structured as a reverse merger in which the operating company merges with and into the SPAC or a subsidiary of the SPAC. The private company is now combined with the SPAC and operates as usual, however, is now a listed and public entity. Now, Ethan will talk about the pros and cons of SPACs.
Thank you, Tim. Compared to the traditional IPO, there are many distinct advantages of taking companies public through the SPACs, which is why there has been a recent rise in popularity. One advantage is that a company can go public through the SPAC route in around 3 to 5 months, with the valuation set within the first month. However, the arduous IPO process can take anywhere from 9 months to more than a year, with little certainty about the valuation and the amount of capital raised until the end of the process. Many companies prefer a shorter timeframe for going public due to the market volatility and uncertainty triggered by the global pandemic, which affects the valuation if going through the IPO process. Furthermore, companies can often negotiate a premium price and have more control over the deal terms when using SPAC, since the SPAC has a limited time window for making a deal, as Tim mentioned before. Contrastingly, in the traditional IPO process, underwriters generally set an initial price below the market's actual valuation due to a conflict of interest. In addition, being acquired by or merging with a SPAC that is sponsored by prominent financiers and business executives can give the target company experienced management and enhanced market visibility. Finally, the target company could potentially lower the transaction fees compared to an IPO. However, there are also several downsides of using a SPAC to go public. One downside is that the company must meet an accelerated public company readiness timeline, as well as complex accounting and financial reporting and registration requirements that may differ upon the lifecycle of the SPAC involved. The target company's management team will need to focus on being ready to operate as a public company within 3 to 5 months of signing a letter of intent. Additionally, The founders of a SPAC get to keep a certain percentage of the equity of the target company, typically around 20 to 25%, as a sponsored promote. This means that a company going public through a SPAC would lose out on a lot of precious equity and would get diluted. Furthermore, as the SPAC process does not require the rigorous due diligence of a traditional IPO, this can lead to restatements, incorrectly valued businesses, or potentially even lawsuits. Logan will now discuss how warrants are accounted for in the financial reports as per current practice.
Yeah, thank you, Ethan. To preface, a stock warrant can be defined as a derivative contract between a public company and an investor. So a warrant gives the holder the right to buy or sell shares of stock to or from the issuing company at a specified price and before a specified date. It's important to note that holders of warrants are under no obligation to buy or sell the underlying stocks. Pertinently, the current practice informing how warrants are accounted for in financial reports in Australia are under the generally accepted accounting rules, also known as GAAP for short. There are two principal rules governing the accounting practice for warrants, which can be summarized as: 1, the issuer must recognize the fair value of the equity instruments issued, or the fair value of the consideration received, whichever is more reliably measured. And 2, the issuer must recognize the asset or expense related to the provided goods or services at that same time. In terms of the timeliness of warrant recognition, the generally accepted rule is that warrants are recorded at the earliest measurement date possible. This could be when the grantee's performance is absolutely complete, or even when said performance is highly probable, considering the costs associated with non-completion. There are other qualifications and conditions that should be considered beyond the two above provided rules when accounting for warrants. 1, in the case of an option expiration, where a grantee does not exercise the warrant for a recognized asset or expense, said assets and expense should not be reversed. And 2, in the case of an equity recipient, where a business's exchange goods or services to be the recipient of a warrant, any resulting revenue should be recognized in a normal manner. Finally, regarding the taxation implications when accounting for warrants, as informed by Week 1 ACCT2542 coursework, a warrant is issued as a single instrument and arguably should be dealt with as a single arrangement. Within the considerations of taxation for financial arrangements, taxation should only apply to the single arrangement. Interest should be deductible if the installment warrants are required to be obtained for dividend or distribution income. Any commission or borrower fee should be deductible over 5 years or less. Franked dividends are entitled to be a franking credit tax offset. Installment warrant lapses where an underlying shares are to be disposed of, capital gains tax must be considered. Now Aisyah will discuss the main accounting issues regarding SPACs.
Thank you, Logan. The U.S. Securities and Exchange Commission, or SEC, have recently put out a statement highlighting the potential accounting implications of certain terms that may be common in warrants included in SPAC transactions. The statement also discusses the financial reporting considerations that apply if a registrant and its auditors determine there is an error in any previously filed financial statements. From this statement by the SEC, there are two main accounting issues that have been identified, which relate indexation and tender offer provisions. Firstly, we will be discussing the indexation, whereby there is the issue of whether warrants should be considered as either equity or liability. Next, for a financial instrument to be classified as equity, it must be indexed against the company's stock. There are two main evaluation steps needed to be done before categorizing warrant as equity or liability, which are: assess whether warrants are liabilities under ASC 480. If no, then assess ASC 815-40 to evaluate if they fall under equity. However, the risk of failing to meet the circumstances of ASC 815-40 may cause an issue. Many warrants are not indexed to this. Therefore, warrants will be categorized as equity if these two settings are met. Firstly, warrants as common stock based on the indexation condition. If there are variables that causes the settlement value to change, SPAC might need to assess if they meet the fixed profits criterion. If the warrant holder received monetary amount that is constant, it is decided that the fixed profits criteria are met. On the other hand, for down round adjustment provision, it will reduce the exercise price of the warrant when the common shares issued by the SPAC are valued at an amount lower than the current exercise price of it, or there will be another issuance by SPAC of a new equity-linked instrument at a price less than the current ones. Secondly, they need to meet the criteria for equity classification as discussed above. Warrants will, however, be considered as a liability if the warrant has to be settled for cash or asset and the above indexation condition is not fulfilled. Based on the warrants issued by SPSC, it has been observed from the fact pattern that there is a provision in the warrants for any possible changes to the settlement amounts. This will be based on the characteristics of the holder of the warrant, and since they are not counseled for the pricing of a fixed-for-fixed option on equity shares, the provision above rule out the warrants from being indexed to the entity stock. To conclude, this evaluation proves that warrants is supposedly be categorized as a liability, with the differences in fair value to be reported in the earnings. Therefore, our view is that the SEC's concerns are valid because the provision prevents warrants from being indexed to the entity's stock when in practice, they must be considered indexed to the entity's own stock for it to be categorized as an equity. We believe that the current accounting practice does need to be changed as it has been categorized warrants as an equity, but based on GAAP, it is misclassified and should be classified as liabilities instead. If the warrants are treated as liabilities, a SPAC will need to update the valuation every quarter instead of just at the initial issuance of the warrants when the SPAC is formed. Jonathan will now discuss another accounting issue related to SPACs.
Thank you, Aisyah. The other accounting issue mentioned by the SEC was about tender offer provisions. A tender offer is an offer to purchase a substantial percentage of the company's securities. Bidders may conduct tender offers to acquire equity in a particular company or debt issued by the company. The GAAP further includes a general principle that if an event that is not within the equity's control could require net cash settlement, then the contract should be classified as an asset or a liability rather than as equity. This was stated in the SEC statement. The SEC also indicated that in evaluating warrants issued by a SPAC, there is a tender provision contingency whereby an offer made to and accepted by holders of more than 50% of the outstanding shares of a single class of common stock, all holders of the warrants would be entitled to receive cash for their warrant. This fulfills the criteria in the GAAP regarding tender offer provisions, further enforcing their view that SPAC warrants should be often classified as liabilities more often than as equity. In this situation, whilst warrant holders would be entitled to receive cash, other shareholders would not be unless they are also warrant holders. There is an exception to this where it could be considered equity, where shareholders also receive cash. Based on the SEC statement, SPAC warrants should likely be considered as liabilities in many cases instead of being commonly reported as equity for the acquisition company. While the SEC's concerns about whether warranties should be classified as a liability instead of equity are valid and adhere to the GAAP principles, there are some effects of misreporting warrants, including possible restatement of financial statements if the changes required are deemed to be important enough. Additionally, as mentioned by Aisyah, reporting as a liability will require revaluation to a fair value each accounting period, which has complexity in itself. The revaluations would also affect the income statement, potentially impacting income tax, and also the arrangement of order in which receiving proceeds, where liabilities often receive proceeds first, and when expensing warrants, in which case warrants would be expensed as opposed to equity, where it goes against the equity. The consequences of the reclassification include the potential missed mergers and a timely procedure for the SEC to provide forms and process filings about restatements, which goes against a reason for SPACs existing, where they are supposed to be quicker than IPOs. Current accounting practice, where SPAC warrants are classified as equity, should be changed in accordance with GAAP principles, where most SPAC warrants are classified as liabilities, and there should be reforms that allow SPACs to change their warrants to liabilities if necessary, without heavy financial burden, and have relief periods. That concludes our presentation for SPACs. Here are our references, and thank you very much for listening.